Good morning. My name is Michael Drew. Today we're going to be talking about options. Welcome to Success Magazine's Investor Education, the 7 cash flow strategies. Now, you likely have been through our class talking about stocks. My guess is that if you've been in either my class or one of the few qualified instructors that have taught our class, you've enjoyed that greatly, and you're committed to furthering your education. And I'm just absolutely delighted to be there for you. Now, I will tell you this. I get a little excited about options because that's mainly how I trade. I'm mainly an option trader. I do, of course, have long-term positions in stocks, but mainly I enjoy the leverage that is made available through options, okay? So folks, if you're taking notes or you're at home, let's go ahead and dig in. Let's let you know what to expect here today. Number 1, rules for success. We're going to go through a pretty specific process as far as the rules to kind of go by as far as option trading. Reminds me of teenagers. If you're a teenager, teenagers don't need to be taught on how to drive fast. They just know how to drive fast, okay? We need to kind of teach you the correct way. If you bend those rules, that's kind of up to you, but you need to know what rules to bend. So we're going to give you the rules for success. We're also going to kind of go over creating a plan. What portion of your account should options be a part of? What percentage returns can you expect? What is your long-term goal? If you saw the DVDs as far as our first section, I'm big into efficiencies, and I'm big into beginning with the end in mind. So if you fast forward your situation here today, I don't care if you're 20 years old or 60 years old or 90 or anywhere in between, where are you going to be in 10 years from now? Part of the reason why I'm so passionate about options is on how they're used and how the people, my mentors, have used them over the past 10, 20, and 30 years. And we'll get into that as we progress through the day. Option basics. Now, through our first day, you learned a little bit about option. An option is a contract that gives you the right to buy a stock, et cetera, et cetera. We're going to go over the basics in detail so you can teach this to maybe a friend or a neighbor, or I hope maybe you can teach this maybe to a son or daughter that you have, because this is going to be a pretty much mainstream way of investing over the next 10 to 15 years and as we progress from there. Forecasting. We're going to talk a little bit about forecasting. Many times I find our alumni students are fighting the trend. That is very difficult to do, all right? Fighting the trend is very difficult to do. It's kind of like a river. If the river's flowing downstream, all right, it's very difficult to swim upstream. It's possible, but very difficult, all right? I'm going to encourage you, folks, to just, trade with the overall market. 2003, the market was generally up. Most of my options were call options. Call options make money when things go up. We did very, very well last year. Is it going to go up in 2004, 2005, 2006? I don't know, and that's not my job to know. My job is to know what tools to apply to what market. So that's where we're going to talk about forecasting and also reading charts. We're going to go over the green arrows and the red arrows. We're also going to give you some support and resistance to how we use those for option contracts. And then really the 7 strategies. Buying call options, when to buy call options, how to buy call options, and when to get out. We never ever get in, this isn't kind of an older wisdom, we never ever get in a business or we never really get in a trade unless we know how to get out. All right? We begin a trade on IBM or Microsoft or GE or whatever you're comfortable with because usually of a specific reason. Either it's a technical or a fundamental or an earnings related reason. We're in a trade for a reason. Consequently, we need to find an exit, and that would also have a reason. I'm mainly a technical trader, so I'm going to talk about the technicals mainly here today. But for example, if a company is, let's just say a drug company, a Pfizer or something like that, or Taro Pharmaceuticals. If a company like this is set to get a FDA phase 3 drug trial approval and a blessing by the FDA that we can go ahead and approve that drug, and if they do get that approval, maybe you're going to trade for that event. When that event happens, then that may be your exit, okay? Whether it's a news event, whether it's an earnings-related event, or whether it's a technical event. We are traditionally in a stock for a reason, all right? In an option trade as well. Reminds me of Yahoo. Yahoo in, 1999, 2000, 2001, don't quote me exactly, but for 12 quarters heading into Yahoo's earnings, the stock would go up approximately 20%, sometimes 30%. Well, after you leave here today and you have some of this wisdom, and especially as you meet our coaching department, which is an excellent department, you're going to learn that a 20% move on a stock could fairly easily create almost 100% move on an option. Just think on what that could do for your portfolio. 4 times a year, we take a small amount of our investment capital and we double it. Imagine what that could do long term. So we're not quite there yet, but just I want you to be open to continually shifting your paradigms, okay? Next, buying put options. That's not very American. We're used to buying things that go up, not necessarily buying things that go down, but put options have been a fantastic way to make money on the downside. Now, many of you folks have been trading for quite a period of time, and in fact, if you're sitting at home, maybe you've been in the market for years, maybe 10, 20 years, and you, like most Americans, have 401ks. And if you're standard 401k, how do we make money in a 401k when the whole market's going down? Well, it's difficult, right? Maybe you have a choice to a beta negative mutual fund that makes money when things go down, or a bear fund. For example, Vanguard has bear funds that are beta negative, that trade downward or short stocks. But that's a little bit difficult. Ladies and gentlemen, the Success Magazine sent me here today because I don't really care, again, if the market heads up, if the market trades flat or it goes down, we can still make money. And think of that as a business. We had in fact, right in the front row, I remember this like it was yesterday, we had 3 people who owned, it was a joint venture that owned a franchise. Has anybody ever heard of Sylvan Learning Centers? Gentlemen, have you heard of those? I've heard of that, and I like that business, okay? And they were in this business, and they said, well, listen, we don't know how to get out of this business. I mean, the only way we know how to make money is in this franchise. I said, well, what is your exit strategy? I mean, how are you going to get out? And they had no idea, all right? So when we're talking about this today, I want you to kind of think in the long term. What business that you're in, whatever it may be, and how we're going to use that. I mean, ideally, what I would think is eventually you would sell that franchise. That would make sense to me, build it up and get a good clientele or whatever's necessary to improve that franchise and ideally sell it for more than it was worth. Well, that said, at age 40 or 50 or 60, then what would you do with the capital? Some people would invest it in real estate. Real estate is a fantastic opportunity. I enjoy real estate. I've noticed, though, the realtors and the real estate investors that come to our class realize my investments and my assets are tied up in real estate, yet they're very, very non-liquid. They've said this before, I'm asset rich and cash poor. And that doesn't sound like something that I'm personally interested in. I'm interested in being both, right? Asset rich and cash rich. So that's where we talk about cash flow. And that's when we talk about our covered calls. Covered calls will talk to us about cash flow. If you remember our DVDs from yesterday, we have number 1 word of money is cash flow. Number 2 word of money is leverage. And I'm all about them both. All right? Those of you who are invested in real estate's a great investment. Ideally, it's for cash flow. You'll also want capital appreciation, right? But I'm very, very interested in cash flow. Very rarely do I get into a property that doesn't have monthly cash flow. All right? And that's where we'll be using covered calls, and that's how we're able to retire hundreds of our students, is we teach them how to pay their monthly bills. That can be done through our covered calls. And we'll also talk about how to find stocks to do covered calls. Literally, there's only, about 20 to 25% of the stocks out there that are even capable to be used in a covered call environment. So we'll teach you how to use and how to find those stocks. Next is our LEAP section. LEAP stand for Long-Term Equity Anticipation Securities. That is a favorite one of my strategies, and here's why. It is what we call almost investing by proxy, or derivative investing. Instead of investing $30,000 on 1,000 shares, we may invest, 6 or 7,000 and control that same stock maybe a period of up to 2.5 years. Okay, so we have a lot of leverage available here to you. And lastly, we're going to talk just briefly about exchange-traded funds, okay? And that is a kind of been tools that have been out there for a little while that have pretty much changed the way we invest. Previously, we would invest in mutual funds, and those are a great way to diversify your monies and your investments. Now we're going to use some index tracking stocks and some exchange-traded funds. So let's dig into it. The business of investing, trading versus investing. Many of you folks have heard, buy a stock and hold on to it for the long haul, right? What does long haul mean? If you don't know what it means, here's what long haul means. Long haul means you're going to buy it and hold it because you don't know when to sell, okay? That's what long haul means, all right? Maybe your brokers have said the same thing, hold on to it for the long haul. Here's the new kind of, let me give you some new wisdom. I'm going to hold on to it, and I like long haul. I mean, I ideally would like to buy a great stock. I'd like to then hand it down to my children, and I'd like them to hand it down to their children, and we, own the stock in the generations to come. However, is that reality today? Yes or no? No, absolutely not. So here's the new wisdom. Folks, I'm in it for the long haul or until it drops. Does that make sense? I don't need to participate in the downward moves. We now have tools available to us that will help us so we don't have to participate in that, all right? We need, and by the way, what we need to give in order for that to happen is we need to have a little bit of desire and a little bit of sweat. All right, a little desire and a little bit of sweat. If you don't have that desire and a sweat, then you'll have to, endure the ups and the downs. If you have a little, if you just run with me, run with your personal coaches, and just be interested in your money a little bit more and see how it can, benefit you and your family. Just spend the, 15 minutes, every day or a few times a week. You will be, your knowledge level will go up, your confidence will go up, and your apprehension of investing in the market will go down. All right. Next is profit from your trades. I know that's pretty basic, but we're in option trading for one reason and one reason only. That's to make money. That's it. We're not in it for the long haul. We are in it simply to make cash flow. Next, to know your tolerance for risk. Now that's kind of near and dear to my heart. I kind of enjoy risk a little bit more now, but let me go back. Folks, I didn't really enjoy this when I first started investing. It kind of reminds me of this. A plane. We have maybe some private pilots. There's always some private pilots in our workshop. If you take that private pilot and you take a look, he launches his plane and he's up in the air. He can make very, very few mistakes. He or she can make very, very few mistakes if that plane is right above the trees. Would you agree? Because if there's some wind or a miscalculation, or I'm not a pilot, or whatever happens, maybe in a mistake, and that plane hits a tree branch, we're in trouble, right? All right? Some of you folks are right there almost in your life. I know that because I was there about 10 years ago plus. I thought I was doing okay. Then when you really look at your financial statement, you're really, your net worth isn't where it should be. Maybe you feel that you're behind the 8 ball, and maybe you feel like I did, is that I should be worth more by now. I'm a bright guy. I take care of my family. I believe in being a good person. Why do I have this credit card debt that I did 10 years ago? Why? And I realize it's just a function of my education. My parents never taught me. So again, knowing your tolerance for risk. If that plane is on the tree line, our coaches will understand that, all right? And our coaches won't recommend things and give you ideas that will be very volatile. But once that plane rises, 5,000 feet if it's a small Cessna, or if you're flying a jet, of course, much higher. When you're up in the air, and let's say you've invested, using round numbers, $10,000, and now you have $5,000 of the market's money, can you then afford to be maybe a little bit more risky on the market's money? Does that make sense, folks? Yes or no? Yeah. So that's really what we want to do is let's get consistent. These trades, kind of like I use the analogy of the first 3 batters in the lineup. Let's get consistent with our trades. And then when we have a little bit of profit, let's learn how to be maybe a little bit more risky. And let's be honest, if you are in your 20s, 30s, and 40s, and you haven't taken any risk yet, and you have $10,000 to your name, are you going to be able to retire in 10 years? Probably not. If you graph, you're 20 years old, now you're 40, and you only have $10,000. No problem. You are, wherever you are, that's where you are. That's fine. But let's do something different so we can get somewhere else. So that's where we're talking about a little bit for your tolerance for risk. Don't get greedy. Literally, it should be fairly non-emotional. Now, we're going to treat this like a business now, okay? This is not an introduction to investing, okay? This is not, we know you're going to be with us. We know you're going to be with the toolbox for a while, and we're going to treat you like that. We're going to treat you with kid gloves. We're going to take care of you. We're going to answer your questions, but we want to recruit you over to more of a logical camp. We're going to make a decision because of these reasons. We are going to sell because of these reasons, not because I have warm fuzzies and I should own the stock, okay? We're gone. That's our exit, or that's our stop loss. That's it. We're fairly non-emotional, and that's how a business owner should run their business, right? For example, if I use this analogy, let's say you're in a trade, whether it's a stock or an option trade, and it's losing money, and it reaches your stop loss point, okay? That is the line in the sand that you say, hey, if it hits this point, I'm gone. What would you do? You would sell, right? Reminds me of if you were to own a franchise. Let's say we have a couple of our students, I remember they owned a Subway franchise. If you've heard of Subway shops or Quiznos shops, okay? They own a Subway franchise, and let's just say you were to do the same thing, and you hire somebody to come work for you, like your family member, like a brother or sister, or I don't know, a niece or nephew or something like that, okay? They come to work for you, and then all of a sudden you turn the corner, and you see them in the cash register right before they leave, and they're just taking a couple 50s and a couple 20s and putting them there in their pocket. And you say, hey, you know what, I'm confused. Help me understand, what are you doing? And they say, oh, I'm just taking some cash flow. I'm going out this weekend. And they say, well, is that, that's wrong. You can't take the cash out of the register. And they says, oh, of course I can. I'm family, okay? And then they say, and by the way, I plan on doing this next week, the week after, and the week after that, and I don't know when I'll stop. All right? Now, as a business owner, what would you do? You would probably, even though you may love your relative and you may feel, warm fuzzies on your relative, a true business owner would have to say, we're going to need to disassociate, okay? We're going to need to cut ties. It's not healthy for the goose. So you folks you're here because we know that you have a long-term time perspective. Treat this like a business. Now that said, if you treat this like a business, and let's fast forward this. 10 years from now, you're going to go ahead and let's say you have a 6, 7, maybe 8-figure account. I don't know. You're going to be, fast forward this, you're going to be delighted that you rolled up your sleeves, that you prepared properly for your coaching sessions, and you were involved. 10 years from now, when you have several hundreds or several millions of dollars, whatever it may be, and you realize that you don't have to work, you're a full-time parent or you're a full-time philanthropist, whatever you want to do, you're going to realize, gosh, I'm happy I spent the time that I learned on how this works. I know I'm going to be investing for the rest of my life. So that's a little bit about getting greedy. If you'll see here, it says know your exits. Not just exit. Look at the plural there. Notice, know your exits before entering a trade. We'll talk about that when we talk about sell stops and also our profit targets. Underneath that, use only a small part of your portfolio. Options are risky. Don't let anybody tell you they're not. Driving a car is also risky, all right? Owning stock, that's also risky. Part of the reasons why you may have heard in your past history that options are risky is options, it's kind of like stock. Let's say we have a stockbroker who sells stocks, and we have maybe a commodities broker and a futures broker, and then we have an option broker, okay? You only have finite money, right? I only have finite money. And if I invest in stock, that very well may preclude me from investing in options, yes? Okay? So even though the moguls, my mentors have used options for years, they've gotten educated, some people who are a stockbroker, they may say, oh, don't do that, it's risky. Or futures, oh, don't do that, that's risky. Or, don't do currencies, oh no, that's risky. Buy stock from me. By the way, who gets the commission? I do. You with me on that? So I want you to have more of a long-term perspective and be educated. I'm mainly an option trader. I do also trade stock, and I'm not that experienced with futures or commodities. I've had my little forays there, and I've decided to kind of get really good at what I'm good at, which is this business model, okay? And then on the bottom here, I've kind of mentioned that. Treat this like a business, and it could pay you like a business. Treat this like a hobby. It'll pay you like a hobby. Now, my goal is to kind of recruit you over to the business mindset. Now, that said, if you're only interested in a few $1,000s a month, maybe you don't need to treat this as seriously as I do. That's fine too. If you're interested in higher cash flow, give it a little bit more time, a little bit more sweat, and it will take care of you, all right? Your personal trading plan, it says have a trading mission statement. Use conservative option strategies to generate 5 to 15% monthly cash flow and never lose more than 50% on any single option play. Now, when it says 5 to 15%, that is per trade. That's not on your whole account, okay? That is per trade. So if we have a trade that's making 5 to 15%, that would be our goal. Also, our goal is to never lose more than 50%. If you are holding past 50%, that's called denial, all right? That's not a river in Egypt. That's bad, okay? That's our line in the sand. Also, if you're you develop a relationship, as you will, with your coaches, or maybe you've met some people who have taken advantage of this options and the discounts we have available here, I would totally encourage you folks to meet and greet other traders. Find people who are doing well in this, and you guys can grow together. Have the abundance mentality and share your trades. Next is your personal trading rules. All the lessons you've learned from the bad investments you made in the past. Friends, I'll tell you this. The ladies and the gentlemen that I trade with, okay, now they're across the world. We used to kind of trade just in Chicago, and we've kind of grown up and moved on, and I live in the Columbus, Ohio area, and a gentleman that I traded lives in the Seattle area. I've got a gentleman now I trade with, he lives in Guam, so he trades, I believe, 11:30 at night till 6 in the morning. I can't remember exactly, but anywhere you're at, okay, every option trader that I've traded with keeps a personal trading journal. Now, it's a trading journal. We don't call it a diary because it just kind of feels weird if you say it's a diary, okay? But it's a journal. So we go in and we say, hey, this is where I've improved and this is where I've made mistakes. You would do this if you had a long-term time perspective, right? So you would look back on your journal and say, wait a second, why am I so, I'm so bullish on semiconductors? Why am I, I keep buying these drug stocks. Why do I keep doing this? Why am I making mistakes? You can troubleshoot yourself if you keep a trading journal. I'm going to encourage that. All you'll need to do is basically give you the criteria of your trade. So, I bought Y, I sold Y, and then an own paragraph. Mine looks like this, February 1st, 2000, whatever. I made this trade because of this. My exit strategy was this. And then my exit. Wow, I made more money than I thought. That's usually how it looks. That's what I like. Or, I may have gotten stopped out because of a news event. We can't control news events, right? Whatever reason. Note to self, do this. Note to self, but you know what I mean? And then I can just read that. Every month I read those, and I'm sharpening the saw. If you remember, I'm a big fan of Stephen Covey's 7 Habits of Highly Effective People. Habit number 7 is sharpen the saw. How are you going to get better unless you know where you're at now, all right? So trade the trend. We're big trend traders, which means we trade with the market, we trade with the sector or the neighborhood or the industry group that it's in, and also the stock. When those 3 are congruent, let's go. That means we have a good possibility of making a profitable trade. Trade long calls on uptrending stocks and trade long puts on downtrending stocks. Long simply means you're long. That means you've bought the call or the put. Let me review a little bit from maybe your stock class. Remember, calls make money when things go up. Puts make money when things go down. Easy way to think of it is a phone call. Call up, put down. Call up, put down, call up, put down. All right? That's it. So long calls mean we would go long. We would buy calls on uptrending stocks, and we would go long puts. We would buy puts on downtrending stocks. Now, we'll start out this day talking about the definitions of options. We'll then go over calls. Calls I understood. I like calls. Buy American. I like buying things that are going up. Puts, I'm not the brightest bulb in the box, but I tell you, puts took me about 2 weeks to understand. To get my arms around that took me a while. I would look at it, somebody would explain it, and I just couldn't. It took me a while, all right? And so that's why we have this on DVDs, and your coaches will walk you through this as well, all right? Long puts on downtrending stocks. Always have a stop loss, either mechanical or mental. Ideally, I'd like it more mechanical than mental, but we'll always have a stop loss. Again, let me reiterate what I've said previously to my workshop classes. Of the book that I read of the 10 most successful traders of our decade, they say the 2 things that they do. Number 1, they always have a stop loss. Number 2, ideally, they sell too soon, which means they do not hold on to the stock, wait for it to drop. They sell too soon, all right? They enter passively. They enter, routinely. I'm going to enter this trade because of this reason. It makes sense. Logically, let's enter. And then they exit aggressively, all right? Hey, if I'm wrong, get out. If my profit is in jeopardy, get out. I mean, it's kind of a yin and a yang, a balance there. Always have a stop loss. Never trade a tip without doing your own research. Ladies and gentlemen, how many of you guys ever got a stock tip and wish you never had that stock tip? I mean, I've done that all the time. One guy, I remember this just like it was yesterday. This gentleman, what was it? It was Arthur Anderson, I believe. That was the company with some accounting hiccups. Is that right? That's a PC way to say it, okay? And I remember this like it was yesterday. A gentleman who was working with the company, I think one step removed, whether it was a client or he knew somebody who works there, he golfed with, I can't remember what it was. He said, you know what, I know all about this stuff. Don't worry about it. Don't worry about it. The company's doing fine. Now that said, is that if who's more powerful, this gentleman who has his opinion or billions of dollars in institutions? Take a guess. It's the institutional money, right? And so whether or not whatever you feel, or whatever, I know this sounds unique, and it may sound even a bit arrogant. No matter what you feel, it doesn't matter a whole lot what you feel. It matters what everybody else feels, right? I mean, if you're bullish, great. But if the overall market it isn't, you're in trouble, all right? So you got to just kind of biased investing can cost you money. I think it should go up because you're going to listen to the market, use our system, and pay attention to the arrows. If you come with an opinion, it can be very expensive, all right? So that's where we talk about never trading a tip without doing your own research, and beware of upcoming announcements. Many times I find students are in trouble because of earnings announcements. Right on the Success Magazine site, you can find out when your stock is announcing earnings. You better know when your stock is announcing earnings. If you don't, look out. Let's go back to what I just said, because we know that we trade on perception rather than reality. Well, when that earnings call happens, can perception drastically change in an instant? Of course. Reminds me of a trade I made. I made a trade. A guy told me that it was a really good stock, okay? So I was already kind of trading on a tip, so I didn't really do a whole lot of research, but he said, we're going to come up with great earnings. And I said, you know what? Thank you. Let me do my own research. Well, I went to do my own research, and I found out he was right on. The company was solid. They had a good market guide ZAC score, 3.25 and above. We had a good price pattern, 2.5 and above, and the stock was uptrending industry group, and the big chart was showing that industry group money flow was good. I said, right on, this looks good to me. We were looking at a stock or an option, and since I wasn't comfortable with the stock yet, instead of using my hard-earned capital for stock, I just used a small amount to buy an option. Well, sure enough, earnings announcements, and it's always very dangerous to trade over earnings announcements, very, very dangerous. So I used a small amount of capital, only, a few $1,000s, and sure enough, the earnings came out, and they were fantastic. Now, I tell you honestly, I do my best to be unemotional, but when there's days when you make, sometimes, $2, $5, $10, $20, or $40,000 in a day, it's easy to become emotional, all right? I fight it the most I can, but sometimes I'll come home after a nice 5-figure day of trading and I'll say, honey, dinner's on me, all right? I'm still human, okay? I mean, I'm as disciplined as I can be, but when the lights go down 4 o'clock Eastern time, I'm in a better mood oftentimes, okay? So then that said, I only had a small amount of capital in this trade, and literally, I was just feeling great. I was saying, wish I would have invested more, And I'm looking through the paragraphs, and it says, oh, we do this, and we have this contract, and we're doing well here. And then, about the 14th paragraph down, these small little paragraphs, it said, however. Now, guys, ladies, however is not a very good word in an earnings report, okay? I mean, just look out, whatever comes after that. And so it said, yada, 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 blah, 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 however. And I was kind of curious now on what came after however. And it said, however, is pricing pressure from our competitors is going to squeeze our profits going forward. So even though our sales look very good, we will have lower profits over the next 2 years. Now, we don't trade on what has happened, we trade on what's going to happen, right? So sure enough, that stock opened up about 10% lower, and I said, I better hold on to it. I mean, I better just hold on. I mean, it's a good stock. Sure enough, it goes 10% lower, crawls up a little bit, and I said, hey, maybe we're okay. And then sure enough, bad news, a bad economic indicator came out, and the whole Dow Jones, everything just started moving lower, moving lower, moving lower. And instead of holding on to it, I'm gone. I mean, I just cut my losses, and away we went, all right? So I'm just telling you, please be very, very careful if, in fact, you hold over an earnings announcements, okay? So that's beware of upcoming announcements, and review your positions nightly. Now, many of you folks are full-time working. That's fine. Review your positions nightly. Why? Several reasons. One, of course, price change. But two, let's begin with the end in mind. Just keep in mind, many of you folks will literally not afford to be able to work in a number of years. 5 or 10 years, you'll be making too much money from this business if you want to treat it like a business. Therefore, if you are full-time like I am and you do become that way, you check your positions nightly, daily, maybe a few times a day anyway. So let's start with that discipline now. I'm big into discipline. I don't know if I mentioned this, but I'm an athlete by nature, all right? So if you'll notice, I'm a little bit competitive by nature. I've played, from rugby to volleyball to ping pong to tennis to, I don't know, I'm good at a lot of sports. I'm not great at a whole lot, okay? But I'm pretty competitive. I'm good at a whole lot, whether it's, I do some skydiving, I do some rock climbing. I really enjoy sports. And that's what I think why I kind of carry that over, because I'm disciplined. If somebody tells me to do something, I listen. All right? If a doctor comes up to you and says, hey, listen, you've got high blood pressure, this, diabetic, whatever you are, you need to do cardio 3 times a week for 20 minutes. Has anybody ever heard of that? Got to keep healthy, right? Low carb diet. I listen, and I do it, all right? If your coach tells you you need to kind of follow these rules, I'm going to encourage you to listen, all right? Is that gentleman or that lady who's your coach, my guess is they have a little bit more knowledge than you do, all right? If you get an email from me and get an email back from me, and I encourage you to maybe follow a certain guidelines, I'm going to encourage you to listen. Why? Everybody wins. Hopefully maybe I'll get a partner out of you. Maybe you and I will be trading, from the beaches of the world together. I don't know. I mean, my laptop has, wireless internet. Have you heard of this? You just boot up your laptop and you can surf the net from anywhere. Well, these hotels I go to, when I go on vacation, I love to go near the pool, all right? And they have wireless internet. So I press the big power button and I surf the web poolside. That's kind of fun for me, all right? I think that's a blast, all right? Just maybe an hour a day, and then spend the rest of the time enjoying. And then when the market closes, all right, take a look at everything and see how it's going, just long term, okay? Why investors trade options? Excuse me. Here's why investors trade options, is it's easier to make money. That's a pretty good reason. It's easier to make money because of these tools. All right? Number one, we can use calls and advanced options to make money when things go up. All right? We already kind of know about that, right? We buy in the greens, we sell in the reds. All right? Kind of a review of what you've already learned. All right? Now sideways. Part of the reason why I'm here, if you remember my story or if you've been in my workshop, I'm going to tell you kind of the right information here. When you're in my workshop, I'm going to give you you've probably already experienced maybe some intimate stories as far as I'm concerned, but I sat in an audience at O'Hare Airport and I looked at this gentleman in front of class. This was when we didn't even have Success Magazine's toolbox back then. I mean, we had Windows 3.1. That's what, I mean, it was DOS based and then Windows came out. It was wonderful. But I sat in front of him and I said, wow, you can make money when things go sideways. And I remember from my training, learning about the stock market, that the markets traditionally don't always go up. A lot of times they churn. They just trade sideways. And yet, why investors trade options is you can make money in a sideways environment. That was very, very attractive to me, all right? Next is you can make money when things go down. We can either use put options or advanced options. And when we talk about advanced options, some of the things that I use are selling naked puts, as well as spread trading. I'm a big spread trader. And in spread trades, I won't get into it in depth, but on average, I win 67, maybe 70, 80% of the time. Entering a spread trade, it's fairly easy to make money about 60, 70% of the time. As you get good, it gets closer to 80, 90% of the time. So just think about that. Long term, if you make 10 trades and you know you have the skill set to make money, 7 or 8 out of 10, as long as you keep your losses to a minimum, you have literally a cash machine, right? I mean, just work it, all right? So long term, that's what we call our advanced options. I do trade a lot of that. So many ways to profit. Let me give you a little background on options themselves. There are 5 exchanges to trade options. The first one, let's take a look at the screen here. You'll see right over here we have the CBOE, that stands for the Chicago Board of Options Exchange. If you're interested in learning more about either the Chicago Board or options in general, they have a fantastic website, www.cboe.com. That's Charlie Bravo Oscar Edward, cboe.com. Moving on there, we have also, and that's the largest as well. Excuse me, the largest as well. The Pacific Exchange, Philadelphia, the American, and the international markets, okay? So we have 5 exchanges. As you progress in your options knowledge and you become more advanced, you may even ask your coaches there's separate brokers that you can use, all right, that you can actually send your trades specifically to different exchanges, okay? So that's a little bit more advanced concepts. If you're interested in that, ask your coaches. Leverage, again, it kind of goes without saying, okay? Leverage is a key way to invest. That's why we're using options. On from there, portfolio insurance, all right? What's the most valuable thing you own? If you guys don't know the most valuable thing you own, it's not your house. It's not your car. Or I hope it's not your car, okay? Ideally, so you know the most valuable thing you own is the following. The most valuable thing you own is your ability to earn money. That's it. All right? So if you're 20 or 30 or 40 years old, you earn, I don't know, let's use a round number, $30,000 a year, you've got 20 or 30 more years to do that. Yes? All right? Now, if you have 20 or 30 more years to do that, and you learn how to trade options, and instead of making $30,000 a year, you then improve that to $60,000 a year, and then you fast forward that 30 more years. Is that amount, 30 years times 60,000, is that going to be hopefully worth more than your car and your house put together? I hope so, okay? So that's what we're talking about there. Portfolio insurance, the most valuable thing you own is going to be your earning ability, and soon it's going to be your portfolio. Why? Here's my question for you. As you're facing it today and you're learning more about options, we're going to roll up your sleeves, why haven't your brokers taught you more about options? That's a good question to ask, okay? The easy answer is they don't get paid to teach, right? They get paid to make money for themselves and their brokerage firm. I understand that. And reduce risk. We'll talk about that here all day. Time can work against you. So the number one difference between stock and options is the following. Options are a timed investment, all right? A stock you don't necessarily have to sell ever, right? You can own a stock, it can go right into the ground or it can go right to the moon. You don't ever have to sell that. However, with options, it is a timed investment. You have to sell it before expiration date, okay? It's a timed investment. And that time can work for you or against you. That's where we get the leverage from. You could lose your entire investment. Ladies and gentlemen, you could lose your entire investment, okay? If you invest $30,000 in a stock, it could go down to zero. If you invest $3,000 in an option, it could go down to be worth absolutely nothing, okay? You could lose your entire investment. That is the way it is. Options are risky. Don't let anybody tell you they're not, especially without an education. With an education, after you finish our course and you finish our coaching sessions, I firmly believe 90+% of you folks will be trading mainly options, because your education is up and your knowledge is up. It reminds me of driving a car, all right? If your knowledge is up, several of you folks, like myself, have probably put on hundreds of thousands of miles, if not over 1 million miles on vehicles, right? If you think about that versus maybe a 16-year-old who have put on 1,000 miles, we are driving down the same streets. Kind of like the stock market. We see the same stocks. Yet the 16-year-old versus the graduates of our class, we actually physically see more. Kind of like a driver. If you have put on 1 million miles, you actually see more. You see the truck driver putting on a signal, or you see the driver do a quick head fake, or you see maybe somebody on their cell phone not paying attention, and you make slow adjustments. You get away from dangerous situations, or you might not, you know what I mean? We just see more because we have more experience. And that's what I'm encouraging you to do. Increase your knowledge and your experience, okay? So you don't lose your entire investment. It can be difficult to pick the correct expiration month and strike price. No kidding. It can be very difficult. If you do not pick the correct expiration month, and if you pick the wrong strike price, you very well may lose money. I'm not interested in losing money, so we're going to be taking notes here today, and we're going to be listening to our coaches. It's generally more complex than investing in stocks. Ladies and gentlemen, that's just the way it is, all right? I remember one time I would ask my dad a few questions, and now I find myself responding the same exact way. My son may ask me a question, Daddy, why is this, or, ask me, he's 3 years old right now, so he'd ask me, and I might respond just how my father would, which he would say, son, that's because that's the way it is. Or maybe another way, because I said so, all right? Or something like that. It wasn't a real, guys, ladies, it's more complex than stocks. It's the way it is. It's a learning curve. You'll be done with your learning curve, and you'll be able to teach your friends and neighbors. I use that humorously, but I've taught my friends and neighbors how to work this stuff. They've come to our classes, and now I have literally a network in my cute little subdivision that I trade with. It's awesome succeeding. When you're going a certain way, when you're heading a certain way and you're making money, is it easy to bring people with you? Oh, absolutely. Yeah. All right. All option traders should have a copy of what's called the characteristics and risks of standardized options. It's going to be a pamphlet, like a little booklet, if you will, that your broker will give you. If you don't have one, call your broker up. They'll send it to you free of charge. Now, that said, I want you folks, my students, I want you to read that book. I know oftentimes you get, offers in the mail like I do for my credit card companies, and there's a stack of stuff you throw away and then, pay your bill and you don't get the free watch or the Bose sound system, whatever, you know what I mean? But this pamphlet right here, the characteristics, what is it? Let me get the quote here. Characteristics and risks of standardized options, I want you to read. If you go ahead and read that prior to maybe your first or second session with your coach, your coaching will be much more effective because your knowledge level will be up, and when your coach uses a word like delta, or we're concerned of, as you get advanced, we may trade with the option Greeks, or we're going to use a collar here, that might be a good strategy, you'll know what they're talking about. It may be a new vernacular for you, and you'll be more experienced after reading this. So when that comes to you in the mail, read it, okay? Read it. It's just a small little booklet. It's going to be, by the way, a little hard to get through in the beginning. Read it a couple times. And then note, highlight it, call the hotline, call your coaches up and say, hey, got a question. I'm confused. Help me understand this, and go from there, okay? That's what we're there for. Option versus stocks, similarities. Both are tradable securities. Ladies and gentlemen, when you got your stock securities, your IBM or your Microsoft, it was just a piece of paper. That's all an option is. It's a piece of paper. It has a different symbol on it. That's about it. So let's say you own Dell stock, Dell computer. On your little stock certificate and underneath your arm it said DELL. All right, that's it. If you want an option, it may say, DEL, PQ or whatever the option symbol is. It trades the same way. It shows the bid and the ask, and it's both traded on listed markets. Who do you transact with? The same broker you do your stock trades with, all right? You'll need to know if they're a live broker or an online broker. Doesn't really matter a whole lot. You may be more attracted to online brokers simply because the deftness of that transaction will be fairly easy. You can manage it yourself. In fact, your broker will email you when your trades and your confirmations come through. It's very easy. Differences, options have expiration dates. That's, of course, the largest difference. And there is no fixed number of options. Now, that's a bit unique. There is a fixed number of stocks. It's called shares outstanding. Microsoft, I don't know off the top of my head, Microsoft has, millions of shares, or was it billions of shares outstanding. Yet options, there's no fixed number. What happens if somebody wants to buy an option and there is no seller at that point in time? The market maker just creates the contract, literally out of thin air. Now, the market maker's job, similar to a specialist on New York, a specialist is to the New York Stock Exchange as a market maker is to the Chicago Board of Options, okay? That's the person who does it. I'm friends with a few of these gentlemen who are down there who are the market makers. It is a wonderful opportunity. By the way, if you're ever in Chicago, I would encourage you to call the Chicago Board of Options Exchange and see if you can get a tour, because it is mind-boggling the infrastructure that is involved in this. It's kind of fun to learn about it, okay? But there's no fixed number of options. The market maker literally will create that. He'll hedge himself. He'll be what's called delta neutral. He doesn't really care what happens to the stock. He'll go home and he makes money on the small little bid and ask price and some other biased tools he uses, but that's mainly what it is. Option buyers do not own a piece of the company, nor do they have voting rights or receive any stock dividends. Ladies and gentlemen, when you go ahead and maybe buy a share of Dell Computer, very rarely would you drive your car over to Dell. You see the big, huge corporation, pull out the sledgehammer, and then just chip off a piece of Dell, like a piece of the building or something, go over and then put it in the trunk of your car. Okay, that's not what you do. You really just get a stock certificate. We actually physically used to get them in our accounts and put them in our safe deposit box. Now in this world of cyber trading, they're all just kind of cyber held, by your brokers and things like that. Options are similar, all right, as far as that you own the right to buy a company. You don't actually physically own that piece of stock, all right? And so in this case, you do not have voting rights. You do not receive dividends, all right? Before we get into the option tutorial, here's something else a little bit different about options versus stocks, is their taxability. I thought that to be a bit unique. The taxability of options is a bit different. Your broker will go ahead and give you a report on all your stock transactions, your buys, you bought this, and then maybe if you have maybe a program or an accounting program, they'll give you your schedule at the end of the year. Whereas they don't report any of your option trades. All right, I thought that to be a bit unique. Now, if you're an individual, options are short-term capital gains. All right, pay your taxes. I'm all about paying taxes. Sure, you want to do it intelligently and use any infrastructure needed through whatever reasons, but pay your taxes, okay? I have some people who have really gone to the next level to avoid taxes. There is a difference between tax avoidance and tax evasion, and it's not just spelling, okay? There's a difference there. I want you to pay your taxes, of course, okay? But I mean, I literally have people now that are using our system to make millions of dollars, and they're very angry, or they get seemingly angry that they have to pay their taxes, and some of these gentlemen have literally gone so far that they give up their United States citizenship. To me, that's too far, all right? I like the States. That's where I live. I'm good to go, okay? Now, that said, I would encourage you maybe to use corporations, okay? If you own a corporation and you use some of your corporate profits to trade, that's just treated like ordinary income. So go ahead and take your tax deductions and your education expense and maybe you need to fly to a seminar and maybe you need to tax deduct that, or contact your CPA. I'm not a CPA, but it's taxed as ordinary income, okay? So just differences there, again, to give you a little feel for that. I'm not a tax expert. I have hired experts. Probably encourage you to do the same thing, okay? So let's get into our option tutorial, getting started. Option account agreements, trading permission levels. You will go ahead and you'll have to fill out a separate option agreement. If you're unsure how to do this, you're welcome to go ahead and either email us or call us and we'll help you through that. It'll be a separate option agreement, and these are the different levels that you'll probably apply for. Number 1 is covered calls. Number 2, buying straight calls and puts. Mainly, if you're applying for options and you fill this out and you let them know that you do have an education, you'll be probably approved for covered calls and long calls and long puts. Now, the reason why you have to fill out one of those, and in fact, I've heard some brokers will maybe even call you up and ask you questions, or maybe even have you fill out a form and maybe pass a test sometimes. I've heard this happen. And why is this? The reason being is because historically 85% of the lawsuits that happen because, in brokerage world, is because people are trading options that aren't qualified, that they don't know what they're doing, okay? Charles Schwab came this close to becoming bankrupt for that very reason. Because brokers know that history, they go ahead and they have you fill out a separate form, disclaimer, so you know what you're doing. On from there, level 3 is spread trading. You won't be qualified to trade spreads. That's not a part of this course. That's part of our advanced options course. Naked options, that doesn't mean that you sit at home and trade stocks in the proverbial buff, okay? All right, that's not the case. That is when you're actually selling options on stock that you don't physically own. That said, initially, a bit risky. Increased knowledge, very savvy way to invest, okay? Let me give you a little hint on that. It's called selling a put, all right? Selling a put. Let me go over this real briefly. Selling a put means you're selling somebody else the right for them to put you the stock. That's basically about it. So I remember this. It was a stock transaction. I called my old broker. You know what? I've had a few brokers. He was a live broker. I have one live broker left. Why does his name escape me? But his name is a moot point. But he mainly was a stock guy, right? So the stock was at about $17.04, if my memory serves me. And I said, well, listen, I could buy the stock for $17.04. And he said, oh, it's great stock. We've got a strong buy, and I, great. I took a look at our Success Magazine Investor Toolbox, and we're good to go. We have solid fundamentals and market guide Zacks, and all right. And I said, okay, great. But wait a second. I've learned now a little bit about options. Instead of buying the stock for $17.04, what I want to do is sell somebody else a naked put. I'm going to sell the naked put, the $17.50 naked put. And for that, they're going to pay me $1.50. Well, wait a second. Wait. Let me get this straight. I'm going to sell somebody else the right to have them put me the stock at $17.50. Yeah, that's right. And they're going to pay me $1.50. Yeah, that's right. Which means $17.50 minus $1.50 means my cost basis would be about $16. And that's basically how it works. If that was too fast for you, no big deal. It's just the first part of the day. We'll talk about this later. So I'm selling somebody else the right to put me the stock at $17.50, okay? For $1.50, okay? Cost basis, 16. So far, so good. So I did my research, called the broker up, and I said, you know what? Forget the stock. That's kind of the old school way. I want to trade options. I want to use leverage. I was taught that leverage is a tool of the rich. So I said, here's what I want to do. I want to sell 10 contracts, the naked puts 1750. And he goes, well, that's too risky. I go, wait, I'm confused. I said you'd sell me the stock for 1704, right? Yeah, oh, it's a great stock. You got to buy it. Buy it. Oh, it's great, great, great. But I don't want to own the stock. I want to sell somebody else a naked put. Oh, that's too risky. Well, let me get this straight. If I sell somebody else a naked put, that means that gives them the right to put me the stock at 1750. They're going to pay me $1.50. Yeah, that's right. That means my cost basis would be 16. Yeah, that's right. But you want to sell me the stock for 1704, and my cost basis would be 16. Help me understand. Well, that's just too risky. You got to buy stock, okay? So again, it's just kind of a little bit of a paradigm shift here, a little bit of a paradigm shift, okay? That's naked options, and then I actually, most of the instructors, I as well have naked index options. That's a next level. I enjoy doing that. Again, even more education and more experience in order to trade that, okay? Naked index options. Option commissions. Option commissions are more than stock commissions, using a round number. There's actually some brokers that are free. Some brokers are $5 or $10 a trade. And you know the most popular brokers. I've mentioned them before, from whatever they may be. The bottom line is that an average trade, as far as a stock is concerned, maybe $10 or $15 a trade. The average option commission is going to be quite a bit more, maybe about $25, maybe $30 a trade, okay? There's some that are a little bit more inexpensive, some maybe a little bit more expensive. That's the basic kind of infrastructure of option commissions. They're a little bit more, they have to do a little bit more work. And I already kind of let you know of the tax considerations of options trading, okay? Get educated on that. If you are interested, go ahead and contact us in our office. We do have some resources for you, maybe some websites we can point you in the right direction for as far as stock considerations go, okay? What is an option? Here we go. An option is a contract that gives the owner the right to buy or sell a stock at a set price on or before a set date. On or before a set date. So let's go back to a real estate analogy, all right? Let's say, I used this before, let's use it again. Let's say I move into your town. I'm going to go ahead and lease option your house from you, all right? So I look at your house. Let's say it's, let me use this example. It's a $200,000 house, okay? I learned a little bit about real estate. Instead of buying the house, I'm going to lease option it, which means I'm going to pay you $5,000 up front. I look at your house, it says for sale by owner. And since it's a FSBO, or for sale by owner, I look at that and I say, well, you know what? Instead of buying your house, I'm going to lease option it. Instead of buying it for $200,000, I'm going to give you a check right now for $5,000 up front. The gentleman's listening, right? And he says, well, help me understand this. I said, well, in that case, I have the right to buy your house anytime between now and 2 years from now, all right? And he says, okay, fine. Well, if that stock goes up in value, or if that house goes up in value, or if maybe I do some improvements, or let's say I buy it, I do that lease option very intelligently, and all of a sudden these $1 million homes start going up. What happens to the value of my little $200,000 home? Take a guess. What does it do? It rises in value, yeah. And so all of a sudden, I put a sign in the, let's say 6 months later, all these homes are getting built, maybe a year later. I put a sign in the yard that says, FSBO, for sale by owner, and my number. And then a couple comes by and they see all these $1 million homes and they're getting discouraged, and they see a beautiful house for only $250,000 today only. And they look at the house and they like it. It's got a fresh coat of paint on it, and they say, yeah, I'll go ahead and buy that house from you for $250,000. All I did is put some paint into it. And they said, well, wait a second. I don't own the stock or the house, but I own something better. I own the option to buy it. And they say, hey, that's fine too. We know that you're a savvy real estate investor, that will work with you there. So we might go through what's called a double closing, where I'll go ahead and they would buy the option from me. They would pay me $50,000, right? And then they would then close on the house. They would then buy the house for what the option says, which is $200,000. They've just spent $250,000. But what did I do? Is I controlled that asset for a period of time, a defined period of time. So you've heard of lease options before. You've heard of this. You've been trading options your entire life. You may have not known what they've been on. For example, you have an option on your house, right? You have home insurance probably. In fact, my home insurance in my neck of the woods is fairly cheap. I don't know, a couple $100, or maybe, I don't even know what it is, $300, $400 maybe, something like that. I have some friends now in the Baton Rouge area and Savannah area, and I said, $200 or $300, and they laughed hysterically. I go, help me understand, why are you laughing? I honestly didn't know. They said, well, it's called hurricane insurance. I go, well, you don't have that in Columbus, Ohio, okay? And they go, no, it's like, $1,200. And I just never knew that, okay? So you don't own a house without hurricane insurance if you're, living in that neck of the woods. I just never knew, okay? So these things that you may not never know, it would make sense to you that you would own flood insurance and hurricane insurance if you lived in that neck of the woods, but I never knew until I started developing friendships from our workshops that we did in that area. Just, new things, okay? Calls and puts. There's only two types of options, calls and puts. Calls make money when things go up, puts down. Let me do that again. Call up, put down. Call up, put down. Call up, put down. Let's talk about a call first. Here we go. Call option. Let's go over that same kind of real estate example and walk you through it. Now, there's paragraph upon paragraph in your workbook on this, so you're welcome to follow along as you're watching the DVDs. Number one, it says we strike a deal with an owner of a house to buy the house for $100,000 in this example over the next 2 years. All right? In that example, we have the right to close the deal anytime over the next 2 years. All right, class, let me get some interaction here from you. If I have the right to close this on the 2 years, can I go ahead and buy the house next week? Yes or no? Yes. Well, how about 3 months from now? How about 1 year from now? Yeah. How about 2.5 years from now? No, because the option is only valid for 2 years. Remember, the difference between stock and options is that it only lasts a certain period of time. And time is very valuable. Just imagine this. You have a house, and in this case, all right, we'll pay the owner $5,000 right now to motivate him to do the deal. That money is his to keep whether we buy the house or not. Well, let me think about that. Time is valuable because that $5,000 paid for 2 years worth of time. If you are here and you're willing to sell me the option on your house to control your house for, let's say, 30 years for $5,000, I'll buy that right now. That would be ridiculous, wouldn't it? Because that time is very, very valuable. So time is a portion of the pricing model that we use for options, okay? Now, the house increases to $200,000. Why is that? Well, $1 million homes are going up, or the developer comes in and says, we're building the new super mall, and we're buying up the houses that are bordering our parking lot, or whatever it may be, okay? For whatever reason, those houses go up in value. Similar to the analogy I just used previously, the owner literally cannot sell the house out from underneath me because I have the right to buy the house from him. Therefore, the house increases in value, our contract has increased in value, and we can either sell the contract or exercise it and buy the house. All right? We can do one of two things. We can actually physically exercise it. So that means we go to our mortgage broker or whatever, we get a loan on it for $100,000. Then we turn around and we sell it for $200,000. In that case, we just made money. What I prefer to do is I actually have set up the contract properly that it says Michael Drew and or assigns. So we can actually physically take that contract and just sell it to somebody else, okay? That's really the purpose. The purpose of options is not to exercise it and actually physically buy the stock. The purpose of an option is to sell it. This is an incredibly profitable business model, and it's kind of investing by proxy or derivative investing. So we don't invest. In fact, you don't even need to show the ability that you can buy the stock. Literally, you can begin an option account with $5,000, and you can control $100,000 worth of stock. You never have to physically, demonstrate the financial wherewithal to control the stock or to buy the stock. So over here, every option contract has 3 parts. We have part number 1 is what's called the strike price. That is the agreed upon price that we are willing to transact at. That is $100,000 in this example. That's our strike price. Now, as far as options are concerned, the basics of options is that the strike prices, if the stock is between, let's take a look at the slide here. If the stock is between $5 to $25 a share, the option strike prices go in $2.50 increments. Therefore, it goes 5, 7.5, 10, 12.50, 15, 17.50, 20, 22.50, and 25. If the stock is in between $25 and $200 a share, we have $5 increments. And therefore, we have 25, 30, 35, 40, etc., etc. If in fact the stock is above 200, of which we don't have many right now, however we will, $200 a share, they are in $10 increments. That's 200, 210, 220, 230, etc. The strike price is the price at which you agree to strike the deal at. All right? Next is the date of expiration. You choose the date of expiration. If you choose that wrongly, you very well may lose your money. Okay, so we're going to go over that extensively. We're just kind of defining the terms right now. The date of expiration. You choose it. It's monthly. Now, technically, options expire. Many of you didn't even know this. Options expire at 11:59 a.m. on the third Saturday of the expiration month. Many of you know that we can't trade on Saturdays, so for all intensive purposes, option contracts expire on the third Friday of the expiration month. Sometimes there may be a holiday event on that Friday. If that's the case, the third Friday is a holiday. The option expiration is on the third Thursday. Okay? So instead, options expire monthly. There are options that expire in January, the third Friday of January, third Friday of March, third Friday of November, whatever it may be. It's the third Friday of those months. Over here, this is the premium. In this circumstance, we paid $5,000. What's the max we could lose? $5,000 in this example. Okay? In options, the premium is the money that exchanges hands when you buy or sell an options contract. So we see on the left-hand side over here, we have calls and puts. You receive the bid price when you sell an option. So on the left-hand side here, if you were to sell an option, you would get $2.60. Over here, if you were to sell the put option, you would get 95 cents. You pay the ask price when you buy an option. So let's go right over here to the call area. If you were to buy this option right over here, you would buy it for $2.90. If you change your mind and say, oops, you know, I messed up. I bought the wrong option. You turn around immediately and sell it, you'll be selling it for $2.60. That would be the bid price. I've given several examples of that. It's kind of an easy way to think of it as wholesale retail. Wholesale retail, okay? We buy it full retail, and unfortunately we sell back at wholesale. Some guy says, well, that's a racket. Well, you know what? That's retail, right? It's the same thing that your grocery store does, whether it's a Winn-Dixie or a Kroger or a Meijer or a Albertsons, whatever it may be. It's the same thing that they do. They buy it wholesale and they sell it retail. Finding an option quote. You go right over here to the left-hand side of the Success Magazine Investor Toolbox. You click on, in this example, it's PMI, and you come up with PMI Group. You go right over here to Listed Options. Click on Listed Options right over here, or you can go ahead and click on this little optionable link. Either one of those is the same thing. It'll pull up what we call an option chain. This right over here is PMI Group. That's the stock. You can see the stock is last trade at $38, okay? Net, bid, ask, etc. It's $38.14. Right over here, these are the November 03 options, the calls and the puts. So we have November 03. The strike prices are in the center. Over here, this is the December 03 options. Calls are on the left, puts are on the right, okay? The option ticker symbol. With stocks, we know, depending on the exchange, we have, our 2 or 3 or whatever it may be, ticker symbol, maybe over the counter, maybe more symbols in the ticker. Well, on options, there's a specific criteria that it follows. Number 1, the first symbol, you'll see right over here on the left-hand side, we have symbols, this is PMI. The first few letters, whether it's 2 or 3 letters, is what's called the option root symbol. The next letter is the option expiration month. In this case, if you'll see, let's look, everybody, if you kind of look at this graph right over here, see it's the next letter is LLLL. That's because that is the expiration call or the put month, which means all these options are in December 2003. If you'll notice that those are the options, the option call or the put month that they're in. Right over here on strike price, that in this case is H. H is right over here. H stands for the strike price. So in this case, H is for the $40 strike price, okay? So let's do an example of a call option. ABC, fictitious company. ABC currently trades at $26 per share. You think it'll rise in the next few months. Why do you think it'll rise? Well, maybe you had used our platinum services of our Turbo Search. You realize that it has a market guide ZAX of 3.25 and above. You realize that it's an uptrending neighborhood, an uptrending big chart. We have 3 green arrows and a heavy volume spike. Everything we've been talking about in our stock class. Instead of using the stock, we now use the option. You buy an option contract that gives you the right to buy 100 shares of ABC for $25 a share. All right? Your contract expires in 3 months. So again, if this move happens after 3 months, you're out of luck. Remember, it's 3 months in this contract. You pay $2.50 per share or $250 for the contract. So what's the max you could lose? $250. Now, there are 3 things you can do with the option. You can sell it, exercise it, or do nothing and let it expire. Let me review what I've just said. The stock is at $26 per share. You're going to buy an option at the $25 strike price. They're going to charge you $2.50 for the option, and that is going to control the right to buy the stock anytime between now and 3 months from now. At what price? $25 per share. All right. Now that said, the stock is at the stock's at $26, and we have a $25 call. So let me get this straight. I can buy the stock anytime between now and 3 months from now at $25. Well, is it possible? Is it probable? But let me just say, is it possible using our system that we can find stocks that match our forecast? Absolutely. In this case, it goes to $30 per share. In that case, you would sell your option for $5. Class, what's 30 minus 25? It's $5, right? Right. So in that case, we have $5 per share. Now that's the minimum. If there's more time left, you could probably get more for that, okay? So it goes up. Is it possible that the stock trades flat? And your coaches will be running what are called theoreticals, and they'll run models and what-if scenarios with you that'll say, hey, what if this happens? What if this happens? What if the stock does nothing? What if this $26 stock trades perfectly flat and it closes at $26? Well, you bought the option for $2.50. 26, let's do this with my mouse here, $26 subtract the $25 call option over here is $1. That means you could sell that option, that $2.50 option, for $1. Lastly, is it possible for the stock for you to be wrong? It is possible for you to be wrong. Absolutely. There's times that I'm wrong, or maybe you do your analysis and the market just says, you know what, you're going to be wrong. I'm going to take your money today. It's called the way it is. And ladies and gentlemen, it happens, right? You don't invest all your money in one trade. I've got some experience. I've traded millions and millions and millions of dollars, and guess what? There's times that I'm wrong. There's times that I go up in front of the big bad market and they take my money. Doesn't happen all the time, but it's usually on a news event. Can we control news? We can't control news. And so we don't put all of our money in one trade. We use money management that we learned in our stock class, and we don't do this. But that said, yet there's times that it's going to go against you. So you know what? If you're making money, 8 out of 10 times, and you have proper money management, you and I, we're good to go. Okay? This is a business. This is a business. And you'll make some poor decisions. Welcome to reality. All right? Have you made any poor decisions in your life? I sure have. Right? So in this circumstance here, the option will expire worthless. It goes down to $23 a share. All right? $23 a share. Now let's go back to why we have so many people attracted to options. Well, let's think. If you were to own 100 shares, now run with me on this example. Here we go. You were to own 100 shares of stock at $26 a share. All right? So let's see. What's 26 times 100? Well, my math says that's what's $2,600. Is that about right, guys? Help me. Yeah, it's $2,600. Okay. I've got $2,600 versus I have $2.50 in an option, controls 100 shares, and I have $250. All right. Now let's run these models: $2,600 stock and $2.50 option, $250. Let's run this model. If it goes the wrong way, it goes down to over here. It goes down to $23. Well, $2,600. Down to $23. That means $2,300. You sell, you lose how much? $300, right? 26 minus 23, that's $300. That's the way it is, okay? You go over here to the option model, you've invested $250, and it then goes down to 23, and your option becomes worthless. Meaning, who would pay you anything for the right to buy the stock at 25 if the stock's at 23? Nobody. It's going to become worthless. You lose $250. Well, wait a second. The stock buyer lost $300 and the option buyer lost $250. There's, again, some leverage available for you. That's, as you progress in your knowledge, that's going to become more and more attractive to you, is investing with leverage. So over here, the stock, again, the same example. The stock goes from 26, on the upside. The ABC stock goes from 26 to 30. That's a $4 per share profit, a 15% return. 15% return. Friends, 15%, that's not bad. But let's talk about the option, the leverage investment. ABC goes from $2.50 to $5. That's a $2.50 profit per share. That's a 100% return. Again, just leverage. 15% on the stock and 100% return on the option. So a call option is the right to buy the stock at a set price on or before a set date. You pay money for this option contract. So that's a review of the option contract. That's the right, not the obligation, the right at a set to buy a stock at a set price on or before a set date, and you pay money called a premium. You pay a premium for that right. Okay. The call option is the right. The set price, we call it strike price. On or before a set date, that's expiration date. I'm defining these terms because I'm going to use them fairly fluently throughout the day. And you pay money called the premium. That's the composition of a call option. Now that said, let's talk about a put. Now, everything I've just said, flip it upside down, all right? Most of you folks are bobbing and nodding at home. Maybe you're taking notes. You're on page, whatever page you are in your workbook, and you're thinking, I get that. That makes sense. Again, I had trouble with puts. This next section you may have trouble with. I certainly did. If you get it right away, you're better than I. So let's dig into it. Put option. We strike a deal for someone to buy or insure the house for $200,000 a year. Anything happens to the house, they will, what we call a put option, kind of like home insurance, is they will put it back. So if I have my garage that burns down, all right, for whatever reason, all right, the home insurance contract is, and my house becomes, worth less, the home insurance says we will put it back. If the roof flies off, they will put it back. That's what a put option will do, or a home insurance contract will do. Well, let's use an analogy here. Let's say you have a neighbor, and the neighbor doesn't like you very much, all right, and for whatever reason. And let's say you're going on vacation. Let's say you're going to skiing, maybe to Utah, or maybe you're going to ski to Vail, Colorado, one of my favorite places to ski, or maybe July 4th. I don't care. Maybe you're going to Mardi Gras. Wherever you go, let's just say let's say you're going skiing, okay? You're going to Vail, beautiful, beautiful resort, Vail, Colorado, okay? You go there, and your neighbor says, you know what? I really don't like you. Every time you take out your garbage, gosh, I'm disgusted about you. And in fact, anytime you go to work, I would wish, maybe I get ambitious, and I'm going to burn your house down. Oh my gosh, that's not a very friendly neighbor, right? Well, you say, all right, well, listen, I've got home insurance, not worry about it. So you go, you take your vacation to Vail, Colorado, you do your skiing, you hit your double black diamonds, and you come home, and there was a fire at your house, okay? Your neighbor set fire to your house. And in this circumstance, that's not a very friendly neighbor, right? Maybe you'd consider moving, or maybe being a little nicer, maybe slowing down in the subdivision. I don't know, whatever you want to do here. But if the house burns down any time before the year expires, our loss is covered up to $200,000, okay? Well, we pay $2,000 premium for the policy. We do not get this money back even if the house burns down. Everybody stay with me on this, okay? If you pay a premium for insurance, they never refund your premium. They don't do that. They'll pay on the policy. They don't refund your premium. Humorously, I went into one of my good friends. His name is Bruce in Crystal Lake, Illinois. He's a fantastic State Farm agent. He's been with me for years and years and years, and I watched his beard go from dark to white and his golf score go lower and lower and lower, and he's doing very well for himself. And I went into him one time and said, Bruce, I've been paying money to you for all these years, and I've never used your insurance. All right? I want you to pay me all my money back. And he laughed. He said, come on back, let's go to lunch, something like that. You don't get your money back, do you, if you don't lose the policy, right? That's what's called an option. You don't get it back. So in this circumstance, we have a $2,000 premium and a very expensive graphic here, if you'll notice there. That's your house is burning, okay? The house goes down in value to $150,000. And you have a contract that says that State Farm or whatever great insurance company, they will put it back. So that policy that you bought for $2,000 actually becomes worth $50,000 to you, right? That house catches fire, there's $50,000 in damage. Our policy covers the $50,000 loss. So that little contract that you have, becomes now worth $50,000, okay? It's kind of unique. The only way you make money on insurance is when something bad happens. I think that's a bit unique, but I guess that's the way it is. Now, you need some insurance. You can be overinsured, but you need insurance on the key things in your life, right? So let's go to a put option example. ABC is currently trading at $34 per share, all right? Everybody, here we go. $34 per share. Okay, got it. $34 per share. You think it'll drop in value over the next few months. Why? Why would you think it would drop in value over the next few months? You take everything from our buy signals and you flip it upside down, okay? So you notice we have a 30-day moving average moving down. We have the stock below the 30-day moving average. The stock rises up to the 30-day moving average, hits it on low volume, fresh red on MACD. The stochastics are just starting to tip over there a little bit. We're noticing we have some red arrows, and the stock's in a downtrend. We take a look at the industry group. We notice the industry group is now starting to keel down a little bit. We click over to the big chart. We notice that institutions are starting to pull their money out. Well, that's a pretty key indicator that a rising tide lifts all ships. Consequently, when the tide lowers, the ships are going to go down. If the institutions are pulling their money, it's going to go down. Great candidate for a put option, all right? I know this sounds a bit unique. I'm all about, buy American and, we like things are going up. But that's not reality. In great times, we can make money when things go down. Is it possible for us to make money when things go down? Did people make money when, let's say, Enron and WorldCom went down? Yes or no? Oh, my word, absolutely they made money, okay? Again, different skill set, maybe a little bit different education, okay? So you buy an option contract that gives you the right to sell 100 shares of ABC for $35 per share. Hold on. The stock's at 34, and you're buying the right to sell somebody else the stock at 35. You're going to actually buy the right to put them the stock at 35. That's what a put option is. To sell them the stock at $35 a share. The contract expires in 3 months. All right? So that is 3 months worth of time. Instead of you having the right, a call is the right to buy, a put is the right to sell. So instead of having the right to buy something, you now have the right to sell something. A yin and a yang, okay? All right? Here we go. You pay $2 per share or $200 for the contract. What's the most you could lose? $200. So far, so good. There are now 3 things you can do with your option. You can sell it, exercise it, or let it expire. So again, let's go over this. The stock is at 34. Let me go over here. The stock's at $34 a share. You are bearish on the stock. You buy an option contract that gives you the right to sell the stock at $35 per share. Now that said, the contract expires in 3 months. You pay $2 a share for the contract. There are 3 things you can do. Now let's find out what we can do. The $35 put. If in fact that you're wrong, and the stock actually goes up, you'll lose money. If you're right, you have the right to sell somebody else the stock at $35. In this case, it goes down to $30 a share. You sell your option for $5. Now, hold on one second here. Let's do the house example. The house is $200,000. I have the right to put it to my insurance company for $200,000. It then becomes worth $150,000. And I've got the right to put it to them at $200,000. That means my contract's worth something. The stock's at $34 a share, and I'm right. It actually catches fire. It becomes worth less. I have the right to put it to somebody else at $35. What's 35 minus 30? That's $5 a share. Then now my put option is worth $5 per share. That's about it, okay? Again, took me a while to understand it, but that's the concept. Now, before I move on here, this is a bit unique. You do not actually have to own the stock in order to buy a put on it, all right? So for example, if I have a home insurance contract on this gentleman's house, this house, and this house, a home insurance contract for whatever reason, and all 3 of these houses start on fire, and I have a home insurance contract, does anybody know what that's called? That's called arson, first of all, okay? But if I were to have a home insurance contract, and all these, I don't have to even own the stock, or I don't even have to own the house, excuse me. See, I'm using that interchangeably. And they burn, I get paid. So if I look at a stock, and folks, and just now borrow from your past. Borrow from year 2001 and 2002. Could you have found stocks that are going down? You know, one student, I remember, raised their hand. Yeah, any stock with a vowel, it was going down, okay? So I'm like, okay. So you know we can find this in bearish environments. And now the blinders are coming off saying, I'm open to the fact that I can make money now in a bearish environment because I'm betting that it's going to go down. All right? Again, new way of thinking a little bit. But let's take a look. Is it possible for you to be wrong and instead of the stock going down, it trades flat? Well, absolutely. You have the right to put somebody else the stock at 35 and the stock stays flat at 34. You bought your option for $2 and now it's only worth $1. And if you remember, is we sell all of our options at a 50% loss fairly non-emotionally. We don't warm fuzzies about it like the guy's taking money from your register. We're gone, okay? So we lose 50%, we're gone. We were wrong. That's the way it is, okay? And if you're really wrong, you thought the whole thing would go down and you're wrong, it goes up. Is that possible? It's possible. And take a look. In that circumstance, it goes to $37. The option will expire worthless. Why would that option expire worthless? Let me think. The stock's at 34. I'm betting it's going to go down. I'm betting that I'll have the right to put it to somebody else at 35. Now, it then it becomes worth 37. If I have the right for somebody else to, sell the stock at 35 and it's worth 37, it's going to become worthless. Think about this. If I have a home insurance contract on a home worth $200,000, and then the home becomes worth $250,000. It's going to become worthless. I need to go ahead and follow the trend, like the option is concerned, and make sure I'm betting that it's going to go down. The trend is your friend. So the right to sell, okay? So everybody run with me on this one. Here we go. A call is the right to buy, and a put is the right to what? Sell. That's it. You've got it, okay? So that's the right to sell, put option, at a set price. That's what's called the strike price. On or before a set date. The expiration date, you pay money for this, it's called a premium. It's also a premium or the cost of an option. The cost of insurance or the premium on insurance, the same thing. Cost and premium, same thing. Or the option quote, the premium, the cost. I've just said synonymous words, okay? They all mean the same thing. Now, basic elements of an option. It controls 100 shares. We've kind of gone over that already. Expiration date, that's the third Friday of the month, whether it's the third Friday of January, February, March, whatever it may be. Strike price, that is the exercise price. That is the price that we have chosen to do the deal, all right? Premium, that's the cost, the quote, the cost, whatever it may be. Buying a call option review. We're going to review each of these. Let's go. You're forecasting that the stock is going to increase. Why? Because you're a student of our system, okay? We're not going to review that. We're going to kind of expect you to know the stock information by now, okay? You're a graduate of that course. Let's move on to the next. You're going to expect to know how to find good stocks and how to know your buy rules and your sell rules. We'll review them a little bit today. We kind of expect you to know that by the time you've reached our option class. Each call option represents 100 shares. You pick a strike price, you pick an expiration month, and you pay a premium. That's it. That's it, all right? Now, buying a put option. Let me go back and forth here. Look at this. If you look at the slide, everybody focus on the slide. Buying a call option review, you're forecasting a stock increase. Now just focus on the first bullet point. You're forecasting a stock increase. Now watch the slide. Boom. Buying a put option, you're forecasting a stock drop. Everything else is the same, okay? Everything else is the same, all right? Buying a put option, you're forecasting the stock will drop. Now, let me give you some key definitions. These are maybe a little bit confusing at first, but here's key definitions. Number one, at the money. An option with a strike price that is equal to the actual stock price. In the money, the option actually has value if it is exercised at the strike price. And out of the money option has no value if it's exercised at the strike price. An easy way to remember out of the money options is that if you trade them, you will soon be out of money, okay? It's an easy way to remember them. So let's follow with me on this visual. Let's say it's a call option, okay? Let's go back to calls. I know they kind of did that put foray there. It's a little bit harder to understand, but we'll get it. All right, let's say the stock's at, I don't know, let's say $32 a share, okay? $32 a share. If the stock's at $32 a share, the at the money option would be the closest. The options are either 35, 30, 25, every $5, so 25, 30, 35, 40. Well, from 32 down to 30, that's only $2, so that would be called the at the money. It's the closest to the current stock price. Anything that's above is called out of the money. So your 35, 40, 45, 50, those are out of the money options. All right? And then anything below 32, like the 30, the 25, the 22.50, et cetera, those are called in the money. Okay? In the money, the closest is the at the money, and then anything that's above the current strike price in a call option, those would be out of the money. Okay? Out of the money, at the money, and in the money. All right? Just terminologies. We'll be using them the rest of the day. Your coaches will also be using them. Warning. If you ever see two contracts with the same strike price, but different symbols and prices, stick with the contract that has the normal option root symbol and the highest open interest. If you're not sure, always call your broker before you place a trade. Most of these contracts are odd contracts created as a result of corporate action and usually have an odd number of shares. So friends, this is kind of what it would look like. Big fish swallows little fish. All right? And anybody who owns little fish, you get 0.6725 shares of big fish company. Well, if you own options on little fish, then you have 0.672, options on big fish corporation. Now that said, if you notice an odd, figure there, be careful of that. Call your broker up. By the way, call your broker. Don't call me. Don't call, your coach. Your broker is the litmus test. We will coach you. We'll work with you. But your broker, he or she is the one that, that they give you the profit loss happens there. Your education happens here. So call your broker. They're the final word, right? So call your broker up and say, hey, listen, I've got, and you'll notice it. It kind of will stand out. I've got these symbols, these, let's say ABC, FJ, ABC, FK. All right, those look nice. And then I've got, XXZ, FK. Well, it just totally stands out. I mean, it doesn't even look the same. And the bid on my normal options are one's $1, one's $1.50, one's $1.75. And then these ones with a unique symbol, it's $15. Or it's maybe super cheap. Oh, it's 20 cents. Everything else is $1.50, and this is 20 cents. And some of you will think, well, I'm getting a bargain, okay? All right, no, that's not the case. Is many times, instead of controlling 100 shares, it only controls 37 shares. That's why it's only 20 cents, okay? So it's not correct. We don't spend a whole lot of time on that on the workshop because it happens less than 5% of the time. And let's say big fish swallows little fish, that's going to be over. Those options are going to expire, and then it's no longer the case. So after Cisco buys that small company, or after GE does a merger, or whatever it happens, it goes from there. This also can be very profitable if you'll ever notice companies that are move in and out of indexes. This is a little bit more higher level stuff, but if you'll notice a company is being bought, there is what's called a queue, or there's a line of stocks that are ready to go into an index. So let's say, for example, we've got 500 stocks in the S&P 500, and all of a sudden there's a deal. All right, we buy you, you buy me, or we do a deal together, and one of those stocks literally gets eaten up or does a merger, and they're in the Standard & Poor's 500. Now there's a space in the Standard & Poor's 500, okay? Well, there's a queue of stocks that are ready to go in. All right, so the next stocks in queue, they're ready to jump in, and we've actually been very, very profitable playing options on that. Why? Because mutual funds, their job is to mirror or outperform the Standard & Poor's 500. That means oftentimes they'll buy the stocks in the Standard & Poor's 500, and if we've got the new guy on the block and we don't own them, we want to mirror that behavior, we're going to go ahead and pick up some of that stock. So options on those stocks can be very, very profitable. It's more of a trading little trick that we used to use, and we still do. Not a whole lot of buys and sells are happening on the Standard & Poor's right now, but that's a little bit of a warning. Now, let's go over the rules to live by. Number one, only invest money that you can afford to lose. Only invest money you can afford to lose. Now, friends, if you email me and come to me and say, hey, Michael, I have got to make money on this trade, and I'm confused. I'm losing money right now. Help me understand it. Where we went wrong is in the first sentence. I've got to make money. That's where we went wrong. If you are trading with your car payment, your grocery money, or your mortgage, is it possible for you to become emotional? Yes or no? Amen. Yes, absolutely. You will become emotional. Yeah. So we don't trade with, the mortgage money. All right. We trade with money that is earmarked for risk capital. All right. The trend is your friend. I'll be saying that all day here today. The trend absolutely is your friend. We need to buy stocks in uptrends. We need to buy calls on stocks in uptrends. We buy puts in downtrends. Now, most of you folks that are taking this will be learning about buying stocks and calls. And soon, the market will head down, yes? I mean, it's gone up 25% in 2003, and we're very bullish in 2004 and 2000. We don't know. But if, in fact, not if, when in fact we get Alan Greenspan tightening up the screws, slowing down the economy a little bit, It's going to happen, all right? When he does that, and some of these stocks start tipping over a little bit, you'll be very delighted that you now have the knowledge to make money in flat environments and make money when things head down, okay? The trend is your friend. Time is your enemy. When you buy time, time is your enemy, all right? When you buy time, time is your enemy. When you sell time, time is your friend, all right? When you sell time, time is your friend. If you're wrong, get out. Let me rephrase that a different way, all right? Everybody, focus here. If you're wrong, get out, okay? Make sure that's focused, okay? That's about it. If you're wrong, get out. Remember asset allocation, all right? Asset allocation simply says as many stocks trade in sympathy with one another. I used an example before that the airline industry. The airline industry, we had bad news in the airline industry. Business travelers were not traveling. They're, just, doing things on the internet and video conferencing, and nobody was traveling. And United, American, Delta, they're all doing kind of bad. Well, then sure enough, Southwest Airlines, which was making money, they tanked down too, all right? So just remember asset allocation. I would not invest all my money in any one industry. Now that said, again, you don't need to be the jack of all trades. Get to know a few different industries very, very well. I have a few industries that you'll be hearing from me in the workshop, or you email me, or you subscribe to a newsletter that I work with, and you'll know what I'm trading, all right? And that said is when Alan Greenspan does something, or when the Michigan Consumer Sentiment comes out, or when housing starts come out, or whatever economic indicator comes out, I know how my stock and my industry group will react to that because I'm spread out. I'm understanding different asset classes. Invest the same amount in each play. If you have $10,000 in your account, we don't put $9,000 in one trade because we're very excited about it, and we only put $1,000 in the trade that we don't think will go well. Well, first of all, don't put $1,000 in something that you don't think will go well, and you don't put 90% of your money in another trade. An easy way to do this is to use the same amount in each trade. So for example, $2,000 a trade, or maybe $1,000 a trade. That said, if you're watching these DVDs, all right, and if you're at home or whatever you're at, your job initially is not to become a millionaire by Thursday or Friday of this week, okay? That's not your job. Your job is to learn how to trade, okay? The markets will be around. Your skill set needs to rise. You need to learn these tools. Your job is to learn how to trade. If your coach says, hey, you know what I'd recommend? Maybe you pick up this book. Or I recommend maybe you do this or follow. You know what I'm saying? If they recommend that stuff, you know what? I want you to get up early, stay up late, and learn it. Because the Boy Scout motto is be prepared. Opportunities will come this year. They'll go to the people who are prepared. Does that just make logical sense? Yes or no? All right, good. Invest the same amount in each play. Focus on a few strategies. Friends, there's 7 strategies we're going to talk about today. 7. I don't trade all 7. I use them every now and again. I focus on a few that I really, really like. So don't be the jack of all trades, master of none. Don't overtrade. That is a common problem. I've had that problem, all right? I've had where I go to the market, and it's been a week's worth of time that I've even been involved in day trading, all right? There's circumstances that the market is very favorable. It's fairly easy to pull, $500, $1,000, maybe $2,000 a day out of the market. That's kind of fun sometimes, right? And you can get addicted to that. It's almost like a drug. There's books on it, on how to treat it. It's like an addiction almost, okay? Now that said, please be very, very careful. That's why you should have a trading journal and maybe even a trading partner that you say, hey, listen, I've lost $10,000 this week, but I think it's going to come back. No, you need to reconnoiter. We need to take in your horns, your bullish horns, and you need to relax a little bit, okay? Be careful of that over trading, and use stops to avoid large losses. Absolutely 30 to 50% on an option. All right? Now, what I've gone over here, let me summarize. What I've gone over here today is the kind of a review. Let me review. I've gone over a little bit of what is a call and what is a put. We understand that controls 100 shares. We understand that they have strike prices, expiration months, things like that. And however, now what I'm going to move to is how do we use this, all right? How we use these calls and puts, what environment do we use them in, and how do we use those to profit, all right? So we'll be back shortly to learn more about that.